Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community. I'm Nathan Stovall, and on this episode of the Street Talk podcast, we're talking about the impact that the sharp upswing in rates has had on bank liquidity and banks' investment portfolios. As rates have surged higher, we've seen deposits decline modestly across the banking industry, and at the same time, we've seen bank bond portfolios move deeply underwater. And there's been some concern in the investment community that banks will have to recognize those losses to meet their liquidity needs. But that subject has been up for debate about whether or not banks will actually be forced to do that. We have a great guest coming on the show to talk about that prospect and ultimately what it means for the industry to have such large unrealized losses sitting on their books. Joining me on the show is Brett Rabatin, Director of Equity Research at Hovde Group. Brett, thanks for coming on the show.
Thanks, Nathan. Thanks for having me.
So, Brett, starting just with where the industry kind of is, aside if you take out the largest banks who have put most of the bonds they own in held to maturity buckets, where they don't have to mark them to market on a quarterly basis. Most other banks, the bulk of their bonds are in available for sale portfolios or AFS portfolios. And we've seen those marks come in quarter after quarter, and those portfolios come under really sharp pressure. That doesn't impact earnings, as we know, but does impact accumulated other comprehensive income, or AOCI, our new four-letter word of sorts, which flows through tangible book and tangible common equity. And we've seen tangible book come under pressure, and as I noted at the opening, it's gotten plenty of interest from investors. You guys have dug into it a few different ways. Have you seen, while it's getting a lot of talk, have you seen AOCI losses impact bank valuations, though, or is it just getting a lot of talk?
Yeah, sure. So it's been a question all year. I would say in March, we started to have this topic with investors come up, and I think some of the guys on our team were maybe a little more dismissive than I was about it, but we all kind of felt at the time that it was something noteworthy, but maybe it wouldn't affect valuations too materially, that it would be a bit of a net negative. And I think where we've evolved to is, yes, this issue is real, and it's changed a little bit in the past quarter, specifically for two reasons. First, one, while the market can make the adjustment on pricing for core price to tangible book value per share, essentially the larger the mark, the more it becomes edification to investors that essentially the balance sheet has a long duration asset that will be at least a drag on the margin for some time and possibly a net negative at some point, particularly relative to peers. So it will impact earnings. And then secondly, the regulatory ratios obviously do not include AOCI. However, in our conversations recently, it does look like the regulators might actually be looking at the outsized exposures for some certain names and perhaps wanting to have conversations, and we can go into that a little bit more later. But to put some math to it, essentially, if you look at the top 15 names on our coverage list, trading at the highest discount to their 5-year adjusted medians on tangible book, the median AOCI mark is 28% for those top 15 trading for the discount versus 20% for the entire group and only 17% for the top 15 names for trading for the smallest discount to their 5-year median. So it does appear there's some correlation on valuations relative to the size of the AOCI mark on the balance sheet.
Wow. Yeah, I mean, those numbers are pretty compelling. 8% underperformance versus 3% outperformance. Sort of quick math in my head there on what you just said. And I know we're going to get into it more later, but while it's not so much the issue of where it sits today, it's sort of on a go forward, our earnings depressed because of this. But before we pick up on that, though, I want to take into context something that I alluded to at the opening, which is sort of like the point in time piece of it, of whether or not banks might have to recognize these losses. It's something that keeps coming up. People keep on asking us or pushing us about, and I've seen it at other places, that the idea that okay, these are underwater and it's just accounting mark now, but banks are going to have to recognize these losses due to liquidity needs and sell the bonds. And so this could actually become a permanent issue. Do you think that's a reasonable concern from the investment community? And do you have any expectations that we could see that happen?
Yeah, Nathan, it's a good question, and it's one that's been asked many times, and really it's one of the topics that I think gets rotated every week or two as the topic du jour. I think every couple of weeks the top question rotates amongst balance sheet growth expectations, deposit betas, the credit outlook, and then this question about, hey, what if these banks actually have to take the embedded loss in their securities portfolios? And it's fair to talk about it, just given that the Fed's anticipated to shrink its balance sheet. And if you look at the Fed H8 data so far for this quarter, I think it indicates about $160 billion decline in deposits, which is only about 1%. But it's something to think about. But I do think that most banks are on top of this and have enough sources of liquidity from the FHLB, the brokered CD market, and perhaps other sources like fintech. So I don't think it's going to be a broad issue, but it's a fair question that could evolve from here. And that's going to depend on deposit outflows from here for the industry relative to market alternatives. And it makes funding loan growth more challenging than it has been from a balance sheet perspective.
Mm-hmm, mm-hmm. And I've happened to be in the same camp that you just said, and have pushed back on people with fears, saying that there's going to be this massive pressure. And sure, you could have institutions with 100% loan to deposit ratios that look different, right? But the median for the industry was 70, the loan to deposit ratio at the end of the third quarter, compared to 82 in 19, and that's with a nearly 2% deposit decline year to date. And as you just said, we've seen further pressure, but you got a long way to go for where you would suddenly feel like you were even back to pre-pandemic levels. And then on the wholesale piece, I happened to pull those numbers not too long ago too. If you just look at broker deposit concentration or CD concentration or FHLB borrowings, we're half the level we were in 19 on most of those numbers. Again, there could be some outliers for sure, but if you just talk about most institutions out there, there's a long way that they would need to go before they were kind of pushed to that level, it feels like.
Certainly, and we actually wrote a note, an industry note, that a lot of management teams said, hey, this created a strategic planning session for us. We wrote a note showing just what would happen to margins if you had what I would call the reversion, i.e., the CDs moved essentially from 25-30% of funding for our average coverage list to 8-10%. And so what would just happen if you just said, okay, we're going to switch that funding from low cost to current market CD rates, what would that do to margins? And it wasn't necessarily a very pretty outcome.
Well, and to that point, when I've had these conversations with some folks in the investment community, and I've pushed back and said that there's alternatives, the one counter to that I've given a lot of credibility to is, I don't want to pay much for that though. A purely wholesale funded situation, which is kind of what you're sort of alluding to, is that you're not saying that's where it's going to go, but okay, even if there's then now it's not, maybe not a balance sheet discussion, but it's a real earnings discussion.
It is. And this is, Nathan, the thing that's really interesting to me is if you just think I've been on the sell side for a long time, and the street and investors, I think, tend to focus on loan growth. And the situation over time has always been that, banks could grow loans, high single digit, low double digit, in various economic times, but they could never seem to grow their deposits that fast. And so, over time, if you were growing faster than 8% on the balance sheet, you tended to be funding a part of that loan growth with higher costs, what you would call non-core sources. And so it'll be interesting to see if the market in the next few quarters really starts to myopically focus on deposits and forget about loan growth for some period of time.
The lifeblood of the business, at least that's what I was always told. You're getting back in vogue, right?
that is the great thing about this environment is that I am hearing the banks say, hey, and I agree with them that like, hey, it's great that DDA is actually finally be getting its comeuppance as the lifeblood of community banks and actually matters to the margin.
Right. For sure. Bringing back to the margin piece, you talked about this a few times. It almost seems on this issue of AOCI losses that is kind of the biggest issue here. That the one that you can see, maybe not front and center today, but it doesn't take too far to think about it. Okay, we haven't seen funding costs rise that much, but they are rising more. And then there's this issue of, do I have longer duration securities against a world where funding costs are going up? And that might be the issue rather than, okay, we're going to have to purge our balance sheets. Is that kind of what you're laying out there earlier, that I'm looking at a compressed earnings environment going forward potentially for some of these guys?
Yeah, I think that's the logical kind of flow of the argument. And we put in our note today, a little blurb about how people are thinking this could be the early 80s, where all these thrifts in particular had longer dated securities and interest rates went up so much that they were earning such a negative spread on their balance sheet that it created capital issues. And I don't think we're going to get to that level, but I think if you're an investor and you're thinking about the next year or two, it's pretty obvious that the fourth quarter could be another quarter where the margins are a little bit better than expected. But then I think the big thing that the investors need to focus on is, hey, who's going to be able to fairly, maintain that margin year over year by the fourth quarter of 23, because there's looking like there's going to be some potentially, sizable pressure depending on what happens with rates from here. So I think that's really the big part of this question is just what happens with margins and what do banks do to kind of get away from the situation of having these long dated securities portfolios.
On that last piece, on get away from it, I mean, are you alluding to, do you look at restructuring your portfolio? You think, would the investment community be open to that? Do you look at some sort of derivative play to downplay the risk? Or maybe just said simply, take cost up front or pay for it up front to avoid long-term pain?
I think, it would have been pre-Great Recession where you saw that kind of thing be prevalent, where banks would restructure their securities portfolio, they sell some security losses, and the obvious thing is what's the payback on capital? How long does it take, and what does it do to the balance sheet? And I've had a few people I've heard some conversations around it yet, but I think that's still pretty nascent in the space. I think right now, everyone's kind of buckled down and just trying to see how high rates get before they make some sort of action on that. But I think that's certainly starting to become a possible discussion.
Mm-hmm. And as I noted earlier too, we haven't seen deposit rates really jump yet. Everyone's expecting them to go higher, but in a world where maybe the pain was more acute, right now we're more talking about something in the future. We've still had good margin expansion, in part because we kept those funding costs pretty low for the time being. But perhaps that gets more pronounced as we start to see those rates continue to catch up.
Yeah, and I think one of the biggest takeaways from our recent financial services conference, from my perspective, was just that, like you mentioned, rates are moving up, but they haven't moved up much in terms of what banks are paying for deposits. But there's palpable concern that this quarter, later this quarter, early next year, that those deposit betas are actually going to accelerate meaningfully. And it's not because the banks themselves are being too competitive with each other. It's that they're essentially competing against the treasury market. And if you're trying to offer something that doesn't have close to if treasuries are 4% and you're not offering something 3% plus, it's going to be tough to get in new money, just given where the market is as opposed to where your competition is.
Sure. I want to shift back broadly, sort of the view of management teams and the investment community just on this issue of, okay, we're seeing duration kind of extend. Do you think, obviously investors are concerned about this. Do you think that they're going to look even more negatively, maybe put people in a certain box, even beyond sort of, okay, here could be the negative earnings impact, but put them in a different box saying, you guys should have been keeping in mind the prospect that rates were going to go up eventually. We knew that. And now we've lost a little bit of faith in you because you loaded the boat up in your bond portfolio when rates were low, and now rates have spiked. And I know that there's lots of institutions in the same boat here. But do you think it could become a credibility issue for some management teams?
I think it can reflect, somewhat poorly on managements that put too much of a liquidity base back into securities too early. But a year ago it would not have been as obvious as it was that we would get so far up the curve this fast. And I view a lot of this as the fault of the Fed and their management of the overall inflationary situation the past year. Last January, I thought that the Fed would be raising rates by April, and it was pretty clear by March that they were just going to let it run hot. And so, I think late last year, banks should have been, and early this year, banks should have been taking a much more proactive ALCO look at what could happen if rates moved up, just given where inflation was trending. So I think it is fair to look at them and say, well, you should have seen some of this and should have positioned a little differently. And it's certainly the one time that, or a good example of Jamie Dimon being right, staying in cash. That was the correct answer.
For sure. And that was not the common thought as we're seeing play out today. Something else that you mentioned that is kind of been a moving target here that I think is pretty interesting is on the regulatory issue. And that is that we had always said this is not a regulatory capital issue. It impacts tangible book and tangible common equity, but as long as you're not a GSIB, this is not a regulatory issue. Now, most of those guys have put their securities in HTM, so they're protected from reg cap as well. But it's always been kind of stated as that way. Do you believe that regulators are paying attention to this and dismissing this as paper losses, or are they actually looking at it in some of the same ways investors are, or other ways?
Yeah, so this is going to all be secondhand, but I have heard, and one of the other big takeaways from our conference here recently was that there's a trend with how the regulators are starting to look at this. And I think it kind of really starts with, BPOP, Banco Popular in particular, where they've got 16.8% CET1, but 4% TCE. And so when they delayed their capital plan until the second half of this year, people were like, whoa. I mean, the stock immediately underperformed during the conference call that they were mentioning this. And I think people were scratching their heads on it. And to be clear, I don't think that they haven't had a conversation with the Fed in their case, about this, about their plans. I think management is just very conservative, and that's the one. The point is that the regulators will always point to the one ratio that's the weakest, and so it doesn't matter until it does. And so what I've heard from several different sources is that the state and the FDIC are still sticking to the usual playbook and not really going into wanting to have a conversation about unrealized losses in either AOCI or HTM, and not really changing the narrative on it, whereas the Fed and possibly the OCC are starting to look at this and say, well, wait a minute, we've got some banks out there who have negative TCE with just the AFS portfolio, and so we probably need to talk to anybody who looks like that. And then we want to have a conversation. The thought is that maybe the regulators, the Fed specifically, wants to have a conversation with anyone who has a loan to deposit ratio close to 100% and less than 6% TCE. Doesn't mean you're going to have, a conversation that leads to something, but they want to make sure the managements are on top of the liquidity situation and not be in a position where they have to take some sizable loss on an unrealized position.
Mm-hmm. Mm-hmm. And you guys had flagged this in a piece of research before too, just the idea of what could this do to things like capital return, which I thought was kind of interesting too. It's like, it's not a reg cap issue necessarily, but am I remembering that correctly, that there was some indication that this might actually influence things like share repurchase and just broad capital return, even though they might not change their view broadly on your regulatory capital standing, that this could actually sort of enter that conversation?
Yeah, I think, it's several pieces to it, but, I think the banks are all pulling back, and I think there's some that will, do a little bit here and there on buyback, but I think the banks are all pulling back on buyback as a function part of the, sort of uncertain environment. They've seen rates move up dramatically fast, and they don't know how much further they're going to go up. They know they're going to go up more, but how much more, they don't know. And so whether it's M&A or share repurchases, I think a lot of the banks out there are wanting to get a little better clarity on what the environment will look like in 6 months before they do anything with capital. And then I think on top of that, you've got this AOCI issue, and I think it would obviously be a bad look if you were asking for a share repurchase plan and didn't get it approved, or if you were buying back stock and you kind of looks like you may have needed that capital given, the AOCI position, which, could get worse from here. I think the cash flows will start to matter to some extent, but rates could move higher from here.
Yeah, and to that last point, not that you're suggesting this, but one, if you need it, what if you can get a step further and suddenly you're looking to bolster capital later and you had done this? You definitely don't want to get in that position, because should you need to go to market even incrementally, I don't know if that would be that well received for the investment community. They would have just preferred that you held on to what you had.
I've seen one bank raise capital for growth recently on our coverage list. I think everyone decided that it was a good thing, and the only question was, did they raise enough for their growth? But I think if whenever you're raising capital to fill a hole, that's always a net negative for both the financial EPS implications, as well as investor sentiment on the current management team and how they might view them longer term as well.
Sure. Well, real quick in closing, given sort of the dynamics and how, as you said, this has been the topic du jour, and you talked about how it's actually kind of created some disconnect from historical valuations. Do you think are there any opportunities in here where maybe this issue has kind of clouded somebody who you feel good about, or maybe it's put them at a steeper discount than you think is sort of warranted because of some concerns around this issue?
Yeah, that's something I think if you're doing all this work, you always want to try and figure out some way to help investors make money or find situations where, there might be a mispriced security. And so, I think if you look at the names where they're trading for the biggest multiple discount, on our list, I think if you kind of pop up, and I think there are some possible other things that are affecting the valuation perhaps, but I think, in particular, a Cadence, CADE, is a name that we've been highlighting, and it's trading for a 3 multiple plus discount to its 5-year median, as well as trading for a discount to its usual tangible book valuation. And they've got they've got a 35% AOCI mark, and they've got a big mortgage-backed securities book. And so that's something to think about. But I also think that as they continue to get expense savings from the MOE and profitability probably moves higher from here relative to peers, I think it's probably a pretty good opportunity relative to, the overall market. Another one I would point out that I think is being mispriced at these levels is BPOP, Popular, where, we're trading essentially on an adjusted basis below tangible book. And I think you've had a couple of net negatives on it with expenses in terms of guidance, as well as, the delay of the capital plan. But I think this is still going to be the cash cow in Puerto Rico, and specifically Puerto Rico could be significantly unique in this rising deposit beta environment. And the Puerto Rico banks may have very lagging deposit betas. So I think BPOP's another name I would point out as well.
I think that's a great place for us to leave it. 2 good ideas for folks to consider. Brett, thank you so much for coming on the show and get into the weeds with us.
Thanks so much for having me.